Good morning, everyone. We are so glad you joined us this morning. This is Christy Johnson with Premier Companies, and I work on the LTC brokerage side. We are very happy to have John Thomas with Nationwide Carematters to do the training for us this morning. We hope you find it very informative and come with your questions, please. This product has been very successful, and it's the same nationwide as you see on the commercials as well, to give you some focus on that. Carematters offers some really unique features that no other LTC hybrid can offer your clients. Apps are very easy. We have been seeing approvals of 2 days after the phone interview has taken place. And those for you who are in the area of Norfolk, Nebraska, we are having a lunch and learn with John Thomas and Chris Bailey, our RVP, Wednesday, February 22nd. Just give me a call, and we would love for you to attend. And with that, I'll turn it over to John.
Thank you, Christy. Really appreciate that introduction, and good morning, everyone. Really glad you could join us for this webinar. Again, my name is John Thomas. I am a long-term care specialist with Nationwide, and our goal in this call really is to give you a broad picture of what Nationwide offers, but really a training on our Carematters product. It's one of our new long-term care solutions, and one that I think will really benefit your business and give you some opportunity in a new product with maybe a new client or clients that you already have in your book of business. So just a brief overview on Nationwide, and Christy mentioned we are the Nationwide that you see on the commercial, right? If you know a little bit about Nationwide, you've probably seen our commercial. Maybe you've seen a Peyton Manning commercial, and you're Peyton Manning fans. We are a big property and casualty business. That's a big part of our business. We're a Fortune 100 company. Actually, as of last year, 69 on the Fortune 100 list, to give you a sense of the size and scope of Nationwide. But beyond that, we're also a financial services company. That's something that less people know. Beyond just our auto and homeowners insurance, we're also a financial services company. Our financial services company on its own is on the Fortune 500 list. So we are a sizable financial services company. And as a financial services company, we are mutual, which is rare for a financial services company. That we are not a public company. We're not beholden to stock owners. We are a mutual, and so really our policy owners, our policy holders, our investors, they own the company. Right, and if you've seen some of our commercials that say "Join the Nation," when you purchase a Nationwide product, you are becoming a member and owner of the Nationwide brand. And so we're really proud of that. Being a mutual company gives us the flexibility to manage our success, really manage for the benefit of our policy holders, and not to produce profits really for the stock market. And so that gives us the ability to stay conservative in a market that tends to fluctuate, especially in the last few years, has fluctuated quite a bit, right? You'll see some stats here on the screen that we've had $26 billion in operating revenue as of 2015. We've been around for a little over 90 years, and so we are a strong, stable company that you can depend on. A few other points I'll make here about the company. We've got about $5 billion now in statutory surplus, so we're well positioned to ride any storms that might come our way. You'll see our ratings there below: A+ best with AIM, A+ with Standard & Poor. But another thing I'll mention when it comes to the long-term care market, and I like to mention this because it is important when you're looking at long-term care solutions, right? For those of you that have been in the long-term care market, you've seen carriers come in the market, you've seen carriers come out of the market, right? And there hasn't been necessarily a whole lot of stability in the long-term care market. Well, Nationwide, we are a stable company, and we are going to be here for the long term. So that's something I want you to be assured of. Along with our financial services and property casualty business, that gives us a diversified portfolio that really can ride any uncertainty. If you think back to 2008 when there was that the market crash, right? The housing bubble kind of burst. The market fell. A lot of companies were receiving bailouts. Nationwide had a positive year. We actually had a positive surplus that year, believe it or not, when other companies were having a rough go. And the reason for that is we have two different business models that offset one another. When our financial company, because of the market maybe or financial conditions, is having a rough year, our property and casualty business maintains us. And in a year where maybe there's several hurricanes and our property and casualty business has a hard time, our financial business tends to do well. So we have that diversified portfolio that really will carry us long term. So I hope that gives you a perspective of Nationwide, who we are, how we're managed, give you some idea of our certainty when it comes to our products and as a brand, how long we'll be around. When it comes to long-term care, if you know that maybe you have auto insurance with Nationwide, or maybe you're somewhat familiar with our motto, Nationwide on your side, that is a motto that really we have earned as a brand because we live to deliver for our clients in a claim. We've won countless awards for our claims experience, whether it's a home claim, right, maybe a fire, and we live to deliver for that person that's going through a rough time with their home, or an auto claim. That same claims experience, that on-your-side claims experience, we want to deliver in the long-term care world. And so as we talk about the product here, if you look at it through the lens of what really is possible for my client in a long-term care solution, because Nationwide is designing a product, and their goal with this product is to create the most flexible LTC solution for the end consumer, the most flexible and most beneficial long-term care solution. So if you think about it through those lenses, we talk about the product and talk about how it's designed. Now, I'm not going to give a whole lot about the long-term care need. I know many of you are experts in the field. You understand the need for long-term care planning. It's something you talk about quite a bit. This is an asset-based product. Nationwide Carematters is the name of the product. And so it's an asset-based product that is designed to take someone's current assets. Maybe they have money set aside in the bank that's liquid, and we're going to reallocate it as an alternative investment to plan for our long-term care. Now, what folks often don't realize, and I know you're having this conversation with folks on a daily basis, right, is that they have some income sources that they've created for retirement, really what's phase one of retirement, right? And often what they've set aside or what they've invested to create some income isn't enough to accomplish three goals. It isn't enough to create sustainable income for the entirety of their retirement, as well as create inheritance or leave some money behind and pay for long-term care should they need it, right? And so we have these competing goals when we need to pay for long-term care. And so it behooves us to plan, right? Nationwide does offer hybrid products, long-term care riders on our life insurance, as well as linked benefit or asset-based care. I'm going to talk about our asset-based care, which is this third category, the linked benefit contract. And that's the product we'll be discussing today. It really developed out of the hybrid space for Nationwide. We've had a hybrid product for about the last 16 years. It's a qualified long-term care rider that exists on all of our life insurance products. But what we recognize is we did need a long-term care solution, not one that was a life insurance and long-term care solution, but one that was really a long-term care solution. But it is designed on a life insurance chassis. And being designed on a life insurance chassis gives us the opportunity to guarantee premium, so that premium is guaranteed for life. It gives us an opportunity to address one of the obstacles with traditional long-term care, and that is if you don't use it, you lose it, right? That if you paid premium for your entire life and then one of those few folks that don't end up needing to pay for care, then you paid for insurance that you don't get any benefit from. And so having it designed on a life insurance chassis allows us to pay a death benefit or give that client a return for their investment should they not need long-term care. So we'll walk through exactly how the product is designed. And this example is going to give you perspective of the design of the product as well as some pricing. So this example will tell you exactly or give you an indication of what the leverage is. It shows a single premium of $100,000 being invested in our Carematters product. And to give you maybe a scenario as a framework. We'll say this is a 55-year-old female. Maybe she worked for state government for her entire career, and she's ready to retire early. She has a substantial pension that will take care of her income, so her income is fine because she has this pension. But then on top of her pension, she got a bonus at retirement as well as her savings, which has her with a couple $100,000 in the bank. Maybe she has $400,000 or $500,000 in the bank. Now, a big risk to her, right, is if she needs to pay for long-term care, she has a fixed income, that pension. And the assets she's put in the bank to save, that she saved, might not be enough to cover all of her long-term care needs. And so we're going to utilize some of that. We're going to reposition it into this investment. Now, we're going to drop in $100,000. It's going to immediately give us a death benefit of $184.19. That's that initial bucket you see there, and it's represented as a 2-year benefit. In addition to that, we have a 4-year benefit as extension of benefits available only as long-term care. And you'll see that as $360,838. This creates a total long-term care benefit of $541,257. It's payable over 6 years in this example, or on a monthly basis, $7,517. The way this would work, if she were to file a claim and need the benefit, she files a claim, it pays out this $75.17 on a monthly basis, and that's going to exhaust this initial bucket first. Once we've exceeded $180,000 in benefits, it starts to pay out of this next bucket, up to $541,257 as total LTC benefits. Now, if she passed away prematurely and didn't need to pay for care, her family would receive a death benefit of $184.19. So that really addresses that concern. Well, I don't want to invest in something that I'm not going to get anything out of, right? Now, we also pay a residual death benefit of 20%. You see this in a gold box here below. That residual death benefit of 20%, it really is an attached final expense policy. That no matter what you've gotten out of the policy, even if you've used up the entire benefit for long-term care, we're still going to pay your family 20% of that death benefit, or $36,000 in this example. And the reason for that, if you're familiar with other products like this in the market, many of them have a small residual death benefit. It might be like a flat $5,000 or 5%. We decided to offer a much stronger death benefit and position it really as an attached final expense policy. Because if you do have folks that have more of the catastrophic type claim, and a catastrophic type claim, in my definition, is something that's greater than, let's say, 7 years, right? And so they may burn through their entire insurance benefit. Beyond their insurance benefit, they'll probably use up a lot of their personal assets, maybe their family's assets, and so they're left with little to their name. Maybe their family's left in debt, and so when they do pass away, they need help with final expenses. And so having this attached policy, this attached final expense policy, is really huge in helping families that have more of that catastrophic situation, maybe a long-term Alzheimer's care need or something along those lines. Now, to talk about a little bit the flagship features of the product and why it's different from what's available in the market. That last slide kind of gave you the structure, which is very similar to some of the other asset-based care products in the market, but Nationwide offers the only cash indemnity benefit. It is cash indemnity, which means that monthly benefit you saw in the last slide, that example was $7,517. We're going to pay that as cash each month. You can really look at it as an income to use towards your long-term care cost, which is unique. A majority of long-term care products are a reimbursement solution, which means they will reimburse out of that benefit pool up to whatever your cost is. And so if you have costs for in-home care or nursing home care, you submit bills and receipts to the insurance carrier and they reimburse you what your cost is. That's not the case with this product. We're going to pay you a guaranteed income on a monthly basis once you file a claim to meet that long-term care solution. And so that creates a whole lot of extra opportunity. One of those opportunities you see in the fourth bullet point here is informal caregiving. We'll pay you this monthly income for your care, which means you can get that income even if a spouse is providing care or other family members. Maybe it's children that are providing care. you can receive this income, set it aside. If you don't need to pay for qualified care, that's extra income that you save that could pass down to your heirs. Maybe you want to stay in your home as long as possible, and you need to redo your home. You need to pull up the carpet, put down hardwood floors, you need to redo a bathroom and a kitchen. You can use that income for any sort of variety of ways to help you stay in your home as long as possible. There is a return of premium feature, and I'll mention on this next page here. But the return of premium really does maintain a level of liquidity. And so because we're asking for, in many cases, a lump sum investment, that can be a big commitment for folks, right? If you're saying, let's reallocate some of this money that you've worked hard and saved in the bank, let's reallocate it into this solution to give you a benefit for long-term care. Well, you know, for those folks that find that as an obstacle, there is a cancellation feature that if you cancel it, you'll get 100% of money back. Now, there is a 5-year vested schedule. So on our single pay, year 1, the client changes their mind, they cancel the contract, they get 85% of their money back. That does increase by 3% each year. So after 5 years, they cancel the contract, they'll get full return of premium. So that really addresses that concern that, you know, what if I change my mind, right? On top of a single pay, we do also offer 5 and 10 pay options. So you can make a payment of, you know, let's say $500 a month for 10 years, something like that to pay for it out of your income as opposed to utilizing some of your existing assets. Those do also offer return of premium. If you cancel it, once you've made your final payment, the following year you'll get full cumulative premium back. For example, with our 5 or 10 pay, let's say the 10 pay day 1 of year 11, after you've made all 10 years of premium payments, day 1 of year 11, you cancel the contract, you get all of your premium payments back. So that 5 and 10 pay, that's how those would work. Some other things that I'll mention about cash indemnity that you might not realize. There are some unique opportunities with ownership. For our more wealthy clients that have significant assets, they have some different estate designs. Because we're going to pay the owner of the contract, we're going to pay this monthly income. This policy can be owned by someone other than the insured. And so folks that have concerns about maybe their mental capacity when they might need care, they wouldn't have to manage this income stream. It can be paid to a trustee. It can be paid to another family member to receive that money and plan and take care of that insured's care. It can also be placed inside of an irrevocable life insurance trust or other trust. So those folks that have estate tax concerns, they can utilize this inside of an ILIT, an irrevocable life insurance trust, and remove it from their taxable estate so that they're doing some good tax planning, some tax arbitrage, and avoiding more estate taxes. We will pay above the HIPAA cap. If you're familiar with the HIPAA per diem, 2017, it is $10,800 monthly. So as long as our benefit is below that $10,800 or whatever the HIPAA per diem is in that given year, and it has increased, it's typically kept up with inflation. As long as it's under that amount, it is tax-free under the Internal Revenue Code. And so that is a tax-free benefit out of this product. Anything above the HIPAA per diem, it is potentially taxable if the insured is not using that towards long-term care cost. So if they're receiving income from us because we'll pay above it, and if it's above that HIPAA per diem and they're pocketing that money, they're saving it in their personal account but not using it towards long-term care cost, that excess could be taxable. There's never any approvals needed from Nationwide. We'll pay for any sort of home modification. You can use that income any variety of ways. This is huge opportunity for those that are in rural communities, let's say. Maybe it's a farm community and there's not a nursing home in their small community, or there's not qualified in-home nurses in their small community. And so they want to stay at home as long as possible, right? They have folks in the community that are going to provide their care. Well, this sort of product will give them a payment even though they're not getting any sort of qualified care. And so it allows for that sort of informal community care that's done in a lot of our small and rural communities. That's an opportunity with this sort of product. Transportation costs, we often don't think about. If someone in a rural community needed to hire a qualified nurse and they were to drive, from the next town over, maybe it's an hour drive to the home, often long-term care products that are reimbursement and payout will not cover that transportation cost for the qualified nurse to drive to our insured's home. But this product, because you're getting income to use towards your long-term care costs, it doesn't matter. You could use that income however you see fit. Prescription medicines in retirement, right? As we become frail and we need care, our medical costs increase, our prescriptions increase, so a lot of those other extra costs that might be associated with our care can also be paid for out of this income. So just some thoughts and things to envision on how this benefit could be used. One thing I didn't mention earlier in the benefit structure, I gave an example that was a flat benefit of $75.17 on a monthly basis. We do also offer inflation. So that was a flat benefit, but we can add inflation. A 3% simple rider or a 5% compound are available. Those would grow that benefit over a period of time. And so for someone that is planning early, maybe someone between 45 and late 50s or even maybe early 60s and has 15, 20, 25 years before they might need to file a claim for long-term care. That inflation really can make a big difference. They'll see a much bigger benefit when they go to file a claim than they would with the flat benefit. Now, as I'm talking here about the benefit design, you're probably thinking, well, Indemnity, it pays a cash benefit. If we look at other products, it's probably a little bit more costly, right? More costly than the standard reimbursement type of product. And you are right. We offer an extra guarantee on top of what other reimbursement solutions offer. That guarantee is guaranteed income, that we're going to pay out your benefit regardless of what the cost is. And so that extra guarantee is factored into the cost of the product. Now, that being said, we still believe that at the end of the day, in a claim, you're still going to get more out of the nationwide policy, more out of a cash policy. And this example really highlights why that is. It looks at a claim, and these are just hypothetical numbers we'll use to highlight this example, but it's a claim, we'll say, of $3,000 for home health care costs, right? And we know that the average claim across, or historically, has been about 4 years, and so this uses a 4-year example. So in that middle column, a claim of $3,000 a month for 4 years, we have two solutions. A reimbursement solution at $6,000 a month, and a cash solution at $5,000 a month on the right-hand side. So off the bat, if you're looking at two different policies, you might say, well, that's about a $1,000 difference in monthly benefit. Maybe the reimbursement solution's better, right? Well, in this claim scenario, if they go to file a claim and they receive all their care at home at $3,000 a month, that reimbursement policy is going to reimburse $3,000 a month for 4 years. And at the end of the 4 years, if they pass away, that policy is paid out $144,000. Well, the nationwide cash policy is going to pay that full $5,000, even though their claim's only $3,000. And so at the end of that 4-year period, we've paid out $225,000. Now, a little caveat, you see a small, in parentheses here, with first 3 months at 0. Nationwide does have a 90-day elimination period, and that is a calendar day elimination. So we file our claim 3 months from filing the claim, these benefits will kick out. Now, what I understand is, and what you probably know, is that this example is simple. It highlights some numbers, but claims aren't really a flat cost for 4 years, right? What we know about the care need, what we know about long-term care claims, is that they are progressive in need and they're progressive in cost, right? As folks become frail, they start to need a little bit of help, and that help is often provided by family. It often looks like help getting up in the morning, help bathing, help getting dressed, but a lot of other tasks they can complete for themselves, right? And family helps out with a lot of the other things around the house. And then as we bring in maybe an informal caregiver or maybe a qualified home health nurse, right, to come in a few days a week to check vitals and check on their health, and then someone to come in maybe to do some more tasks around the house. And with time, over the next maybe 3, 4, 5, 6 years, that care need progresses to the point where at the end of maybe 6 years, they need round-the-clock custodial care in a nursing home, right? And so we might have cost that starts out at $1,500 a month or $2,000 a month. And then at the end of the claim is closer to that $5,000 or $6,000 or $7,000 a month when they go to a nursing home, right? Because this is a progressive claim assumption, we're looking at an average $3,000 monthly cost over that period of time, which means it started out smaller and ended bigger, right? And this average would hold true, that if you can get to your cash early when your costs are less, you have a huge opportunity to get more out of the policy. And I'll take this a step further. Let's say that this person didn't pass away after 4 years. In this example, we're using these same numbers, $6,000 a month in the reimbursement policy, $5,000 a month with our cash policy. That's our benefit. Now let's say they go to a nursing home for a 5th year. So we had our 4 years at home at $3,000 a month. Now we're going to go to a nursing home. In that nursing home for a year, it's going to cost us $8,000 a month. Well, we know that our reimbursement solution offers us $6,000 a month. There's a $2,000 monthly shortfall if the nursing home costs us $8,000 a month. So in that year in the nursing home, we're going to have to pay out of pocket $2,000 a month, or $24,000 in that final year. This cash policy, it offers up to $5,000 a month. There's a $3,000 monthly shortfall, or $36,000 for that year at a nursing home. But thankfully, because we were getting to our money sooner, we were getting to it faster, and we banked it away in our personal account, we have $81,000 that we've saved in the bank in the early years of the policy. That $81,000 that we've been able to save away is more than enough to cover our $36,000 shortfall, not only just for a year, maybe for 2 years in a nursing home, and still have some left over. So in this example, there's an opportunity to save any excess you have, to be able to bank it for times down the road when your cost goes up. And if it doesn't, this $81,000 or however much you've been able to save to the policy creates some extra inheritance for your beneficiaries, for your loved ones, or can be used for those things around the home, like we mentioned. One other thing I'll mention on informal caregivers, whether or not there's any special requirements. So many of you know with the HIPAA standard for long-term care claims, there are typically 2 things required. First, that the client can't complete 2 out of 6 activities of daily living, those things like feeding yourself, bathing yourself, dressing. So if the client can't complete those 2 out of 6, or cognitive impairment, right, that's typically the first trigger. The second is a plan of care. And with a reimbursement solution or many long-term care solutions, that second requirement is that you prove some loss, right, that you submit some initial bill, you submit some initial evidence that you're paying for qualified care before any benefits will begin. That second requirement is not there with Nationwide. There is the plan of care, but because it's a cash benefit, we have no requirement for proof of loss. And so it's just simply indicating in that claim that informal care is the plan. Doesn't have to be detailed, just that I'm going to receive care at home informally. That's enough for us to begin that claim. And so there is no requirement for a lot of that detailed proof of loss that's there with other solutions. One other thing I'll compare here to give you a sense of where this stacks up with other products in the market. This is a comparison of gross cost versus net cost. I'm going to help you understand that you really can help clients prepare in a cash solution. And these are 2 of the bigger products in the market, and we have Nationwide with Lincoln Money Guard and Pacific Life Premier Care. And it's an equivalent or apples to apples to long-term care comparison. $540,000 of total LTC benefits on a 60-year-old single female. We're showing a single premium with Nationwide of $120,179, with Lincoln Money Guard of $117,669, and Pacific Life $133,738. And what this is intended to highlight is that it does cost more in premium for the Nationwide solution. Yes, it is an indemnity solution. But because we offer that stronger residual death benefit, what I positioned earlier as an attached final expense policy, you're getting a return of some of that premium on the back end. And so at the end of the day, the net cost to the client is less. You see that final row there, the net cost of Nationwide, $84,179, with Lincoln 108 and Pacific Life 128. Lincoln has I believe, a 5% residual death benefit, and Pacific Life a flat $5,000. So that highlights that at the end of the day, the net cost is less with Nationwide, or maybe about the same. A little caveat here, this is Lincoln's 100% ROP option. We've compared apples to apples. They do also offer an 80% return of premium option. With the 80%, this premium is going to be a little bit less. And let's just pretend, for the sake of this example, that their premium is maybe $100,000. So that is about a $20,000 difference in upfront premium. And then with that residual death benefit, we'll say the net cost is about the same. And I would say, well, for two different product options, when you have a net cost at the end of the day that's about the same, would you be willing to reposition more upfront for all the benefits that Indemnity can provide, the flexibility, the ease of not having to submit bills and receipts, and also the guarantee that you're going to get your full benefit no matter what your costs are? Would you be willing to reposition some upfront for all those benefits, knowing that at the end of the day, the cost to your estate is about the same? And I would say that, you know, a lot of people might not think, well, I'm mostly concerned about what I'm putting into it. I'm not so concerned about my estate. Well, depending on what the client has earmarked that money for, they probably are concerned about their estate, right? Because for those folks that have spent a lot of time to save money, they put it in the bank, they have $400,000, $500,000, $600,000 in the bank, right? And you ask them, what are you doing with that money? Well, it's there for an emergency, right? It's there in case I need it, in case I have these unexpected healthcare costs, or I need to pay for long-term care. And we can address their long-term care concern, but if they don't have to use it in an emergency, what are they going to do with that money? Well, they hope to pass it along to their kids, right? They hope to pass it along to their grandkids, maybe. And so what the product cost their estate is important if whatever comes out of their estate is going to go to their kids or their grandkids. And so having a product that repositions less out of their estate at the end of the day can be pretty important. Now, I want to leave some time for questions. So we'll have 15 minutes or so for questions at the end of the presentation. But to highlight a few opportunities where we might find these clients, or what's suitable, where is Carematters suitable, and for what client profile. I'm going to highlight 4 different hypothetical clients to give you an idea of who might be a good fit for this product. And we'll start with those clients that have sleeping assets or cash. And this is kind of the category person that we've been using as an example. That 65-year-old that's retiring, they've got money set aside, they have CDs that are maturing or bonds, maybe they're selling their business, they have proceeds, maybe they have funds from downsizing or selling their home, maybe they even receive an inheritance, right? Those are opportunities where those people have this money that's sitting in the bank and it's really not earning a whole lot. It's in some sort of fixed asset, right? Or those folks closing in on retirement, age 55 to 67. This is a good opportunity to look for those people that can fund a policy like this out of their income. They're in the peak of their earning capacity. You know, they're later in their career. They could potentially afford $400 a month out of their income and get a substantial policy. Maybe they're 59 and a half or older. They have qualified money not needed for retirement income. Maybe it's in a annuity, and we can take some withdrawals out of the annuity or out of their qualified assets over 10 years to mitigate the taxes, and then use that to leverage for long-term care. These 2 other profiles, which can be big opportunities. This third one, those that are over 70. They've hit that 70.5 mark, and they have that required minimum distribution from their IRAs. I spent some time early in my career working for our pension department here at Nationwide, and I can't tell you the number of people that get to 70 and they get a letter in the mail and it says, due to turning 70 and a half, you now have this required minimum distribution and you're required to take so much out of your IRA on an annual basis. And those folks get that letter and they're upset. This IRA I want to pass down to my kids, my grandkids. I don't want to use this. I don't want to take income out of it, but unfortunately, for taxes to begin, they're required to start that income, right? Well, for those folks that get that letter, they're required to start taking money out of it that they don't need. What better opportunity to use that income, leverage it over a 5-pay or a 10-pay into a long-term care solution that will provide for their long-term care should they need it. And then, you know, the asset, that IRA, is protected, because if they have to pay for long-term care, they're not going to have to dip into that IRA, right, because they've used that income to create a long-term care solution. And then the last category, Henrys, high earners not rich yet, age 40 to 55. This is the category of folks that we really haven't, as an industry, marketed to much at all, right, because they're in an early phase of life. They're worried about their kids and their marriages. They're really not even thinking about retirement, let alone long-term care, right? But because they're younger, the insurance is really inexpensive, and there's an opportunity to plan early, especially if they are a higher earner, to pay a couple $100s a month over 5 or 10 years and be able to get the insurance while they're young. And this is a good group of folks to use with an inflation rider. Get an inexpensive policy, but add that inflation so by the time they are 85, they have a substantial benefit. And more and more folks are having these experiences of caring for a parent or caring for a grandparent and seeing that process. And so they are going to be more willing and more open to having the conversation. Where Nationwide is getting a lot of traction with this group of consumers is because of the cash benefit. This group of consumers is a little bit more investment savvy. You know, they are watching their own retirement. They're by and far have less pensions available to them in their employment, and so they're responsible for their own retirement, right? And so they are a little bit more investment savvy, whether they have a 401k or maybe an IRA. And so when you talk about a long-term care solution, maybe they've seen or heard about the traditional LTC space and some of the ups and downs, or they've talked about a reimbursement solution. But we have no idea what the market's going to look like in 30 years. We don't know what care is going to cost. We don't know what types of care will be available. And so looking at a reimbursement solution, you know, is an opportunity, but they may say, hey, you know what, you can't really pinpoint and tell me exactly what my costs are going to be in 35 years, or let alone whether I'm going to have care in home or whether a robot's going to take care of my care at that point, right? We have no idea what care is going to look like. And so there's some uncertainty there, but when you have an indemnity or cash product, you can say, you know, I can guarantee you no matter what care is like, no matter what the costs are, this return when you file a claim is guaranteed. For your investment right now, we're guaranteeing you this dollar figure when you file a claim at this age. And so that's that extra level of return on their investment that's appealing to this more investment-savvy younger generation. So there's some good opportunity there. I want to highlight one final example, or two final examples before we get to questions. This is a simple leverage example for someone that has a CD. And for those of you with CDs, you know that interest rates are low, right? That CDs aren't returning much. But, you know, for the sake of this example, we're going to take a CD, we're going to sprinkle some magic on it and say it's returning 3%. Okay? We know that's unlikely. But we'll put $100,000 in a CD. It's earning 3% at age 88, and this example uses a 60-year-old. So 28 years later, it's about $229,000 in that CD. That does not take into account taxes on the interest, okay? It takes 52 years, so well over this 6-year-old age 100 for that to grow to about $465,000. The same 6-year-old put $100,000 in today, it immediately gives us a long-term care benefit of about $473,000. There's no tax on it because it is built on a universal life or an insurance chassis, so it is a tax-free product. Plus, this attached final expense or residual death benefit of $31,531. So it really is, this example just highlights that for a person that has that response, well, you know what, I'll just leave my money in the bank. It's invested. It's earning a small fixed return. You really can't beat with a fixed investment what the insurance leverage can provide, right? And so in a quick snapshot, that example gives you that perspective. For those of you that have wealthy clients, wealthy individuals that you work with, this example highlights something I mentioned earlier, that you can place the Indemnity product inside of a irrevocable life insurance trust. This example I call the cost of being lucky. So if you're working with a wealthy individual that has a few $1 million in the bank, they're concerned about estate taxes, and as you're doing some financial planning with them, you say, well, you know what, you have all of these investments, you're investing in real estate, we need to put aside some money liquid to take care of your long-term care expenses. And so let's put $1 million in the bank, liquid, let's make sure it's there, it's accessible if you have to pay for these long-term care and medical costs down the road, right? And that might be a good thing to do as a financial planner. Well, this person is lucky. They live a long, full life. They pass away in their sleep in their late 90s. They never need to access that liquid pool of money they created, and so they don't have to pay for care, right? That's the dream scenario for many of us. We don't have to pay for or need some sort of care. Well, in that scenario, with estate taxes and the federal state tax rate of 40%, and that doesn't include any state estate taxes, but just using the federal rate of 40%, the cost to their portfolio where the money that's liquid is $400,000. So they didn't need care, but at the end of their life, their estate pays out $400,000 in estate taxes. Wow, some luck, right? Well, using the irrevocable life insurance and the awesome feature of life insurance that allows us to put money in life insurance and avoid estate taxes on that investment, why not take some of that $400, allocate it inside of our irrevocable life insurance trust, which moves it out of our taxable estate, right? So whatever we move inside of that island is now out of our estate and avoiding taxes. So it's reduced our taxable estate. And if we invest in Carematters, we have a really two-pronged benefit. If they are lucky, they don't ever need care, then their tax-free estate gets that tax-free death benefit. So depending on their age, they may get a 2-time return or maybe 3 times return on their investment as death benefit, which is going to grow their estate tax-free. Or if they need care, they're going to go ahead and file a claim, and because our policy pays the owner of the policy, it will pay the trust. And on a monthly basis, that trust is going to get tax-free income. And that tax-free income might grow the trust substantially over 4, 5, 6 years. And then they've been able to grow their tax-free estate substantially using this long-term care product. And the really nice thing is that, they're a wealthy individual, so they do still have assets that they can use to pay for their care. So they're still going to pay for their care out of their liquid assets. And because they're paying for care, or what we could consider qualified health care under the Internal Revenue Code, whatever they pay in care continues to reduce their taxable estate. And so simultaneously, they're reducing their taxable estate and growing their tax-free trust at the same time. So this is a really great opportunity for some tax arbitrage for those wealthy clients you may have. So I'm going to pause there. I know I gave you some food for thought, and I'd like to open it up for any questions. Christy, did you have some that came across on our chat box?
I do have a couple. The first one is, when do we anticipate the California release?
Great question. Great question. And that's something I didn't mention at the beginning of the call, but I'll mention here. We are available with the product in all states except for California, New York, Hawaii, and Montana. Good news, we have an approval for New York. The product's not available for sale quite yet, but we're getting ready to launch the product for sale in New York, and it should be available in the next couple of months. California, we're working through that approval process. We haven't got it just yet, At this point, we're probably anticipating approval late in the year, which means we'll have the product available for sale probably first thing 2018.
Okay, then I have a question, and I've never been asked this one. On a 10 pay, can you pay it up early?
You sure can. Yep, if you commit to a 10 pay, let's say you pay five annual payments, 5 years of payment, you get some money, you decide to pay it up, you can certainly pay it up. You do have to pay the remaining balance in full, so there's not any discount applied for paying it up early, but if you just want to have it taken care of and paid up, that's certainly something you can do.
Okay. I don't see any other questions, but I had other questions I was answering throughout the whole thing, but very informative. And
well, good.
I really
and
want
Christy,
to thank
one
you
other
for
thing
your
I'll
time.
mention.
Uh-huh.
Yeah, real quick, I didn't mention underwriting. You mentioned it briefly, but it is a simplified underwritten product. And so it does require a telephone interview, but no medical records, no paramed, which means no fluids or blood and urine. We simply do a telephone interview with a client and then a yes or no approval based on that discussion with the client of their medical history. We do average about an 80% approval on all applicants for this product. So we have pretty good, successful underwriting with that simplified process. And Christy, you mentioned 2 days with an offer after that telephone interview. That is accurate. You know, with a client that is available, we can get an interview with them scheduled quickly. We can have an offer and the policy paid within a matter of a few weeks. So compared to traditional life insurance products, this is a very quick product. It's one that you can get underwritten pretty fast.
So here's a question for you, and I think I misunderstood what she was saying. She wanted to elaborate. I guess you said at one point there's no plan of care required. So what is required to go on claim?
Great question. Yeah, and I'll clarify that. The Internal Revenue Code and HIPAA requirements do require that there is the 2 out of 6 activity daily requirement met, ADLs or cognitive impairment. So that's the one qualification. The second is plan of care. So because it's a qualified product, the plan of care is required. But because we don't require proof of loss or require a qualified caregiver to approve a claim, that plan of care requirement is really easy. For those that are receiving informal care, you can simply say the plan of care is informal care. So the plan of care isn't one that has to be developed, and it doesn't have to be real detailed. It can simply be informal care. So that makes that plan of care component really simple and really easy.
So we don't need a doctor's diagnosis? Or we do need a doctor's diagnosis?
Great question, yeah. And so it is certified by the client's primary doctor. So the client's primary doctor would be the one to certify the 2 out of 6 activities of daily living or cognitive impairment, as well as certify the plan of care.
Okay. Is there a return of premium of any kind on the 5-pay or 10-pay after a few years of paying, then deciding not to continue?
There sure is. Yeah, and that's a great question. So we have the full return of premium after all premium payments have been made. Prior to that, if the client were to cancel and change their mind, there is a surrender charge assessed. Now the surrender charge in year 1 is 8%, and then it decreases by 0.5% every year. And so even in year 1, if they can't, if they don't have that full ROP, but they cancel it, they still are going to get roughly 92% of their money back. And so it resorts to that surrender charge. So they will still get a good chunk of their money back, or a majority of their money, because the surrender charge initially is only 8% in declines. So more than likely they'll get a majority of their money back. It is invested in a fixed account within the product that's guaranteed to pay 2%. And so when they do reallocate or allocate their money into this product, they do get that 2% earning on top, or in a growing cash value. So there's an opportunity there to potentially even see growth in their cash value if they hold the product for a period of time.
And the last question that I have is from a New York agent asking when they can get contracted.
Yeah, fantastic. Good question. You can absolutely go ahead and get contracted with Nationwide, and we'll get that process started. We'll get it taken care of. So we can go ahead and knock that out. We'll have the product available to illustrate, we believe, and go ahead and present to clients in maybe late April, early May. We can go ahead and start having that conversation and finalize sales in June, July. Is kind of what we've earmarked. We're hoping to get it all done faster, but that's kind of what we think the timeline will be.
Okay. Is a 1035 available from a life policy?
It sure is, yes. So we can 1035 from old life policies. That is a good opportunity. You have a lot of folks that have some old whole life policies that maybe their parents purchased on them or they've had for a long time, and their kids are grown. They don't really need the death benefit anymore. And a lot of these whole life policies might have, $60 or $80 or $100,000 in cash value. You can absolutely roll those over and say, hey, let's take this death benefit you don't really need anymore and use it for your long-term care protection. So that is a good opportunity.
Next question, does the client receive an annual 1099 for the cost of LTC?
Good question, they do, yes. So they'll get an annual 1099, it's a 1099 LTC. So it's not a taxable event, but it is a 1099 that tracks the cost of the LTC. And that does, it sounds like you're familiar with these sort of products, what it does is reduces the cost basis within the product. So should they cancel it down the road, when they get cash back, whatever the cost of that rider is going to add to the taxable gain they have in the product. So it's really not a concern unless they cancel the product down the road. It's going to be reflected as taxable gain.
Okay, next question. Are you underwriting for life or for LTC?
Yes, yeah, and with these products, we underwrite for both. So it is both a mortality and a morbidity underwriting. Because the bulk of the benefit is long-term care, a majority of the underwriting is for that morbidity. We do look at primarily those musculoskeletal issues and a lot of the things that would affect the risk for long-term care primarily, but there are other things that could affect the approval. Some of the more mortality things like heart disease. Significant heart disease history could be one that could cause a decline. So it is evaluated in the underwriting process.
Okay, for California residents, could they go to Nevada and purchase it?
Yes, there is the potential to purchase it out of state. With the state of California specifically, the regulators look at that and what our requirement is to meet some of that regulation is that the client have some interest out of the state of California. And so whether it's a property, whether it's a business, they have to have some financial interest out of the state of California. So for those folks that have second homes out of the state, they can use that second home interest. Maybe they have a business or they have some other financial interest outside of the state. We can look at that. And a lot of those we'll handle on a case-by-case basis. It's pretty standard for folks with second homes. That works. But other scenarios, we can kind of work through it and see if it's one that would be compliant.
Okay, I think this woman meant a 10-year. In a 10-year, if they make a claim in year 8, what happens?
Yes, good question. So the client will have two options. There's not a premium waiver feature. It does require a full premium be paid, but we'll offer the client two options. They can take a reduced paid-up option, and so if they've paid 8 annual payments on a 10-pay, they've paid roughly 80% of overall premium, well then they can accept a reduced benefit of 80% of the original benefit. So that's the first option if for whatever reason they choose not to continue making payments. The second is to continue making payments and restore or keep their entire benefit, which from a mathematical or benefit standpoint I think makes the most sense in most scenarios, to keep their entire benefit. And the great thing, because it's a cash policy, their premium can be made out of the benefit that they're receiving. So if they're getting $6,000 a month for over a year, they're going to get over $70,000 out of the policy. And if they have an $8,000 annual premium, they can easily make the premium payment out of the benefit that they're getting.
Okay. How is gender regarded?
Yes. Yeah, it is underwritten on a gender basis. Because the product is priced with a blend of morbidity and mortality, because there's a death benefit and long-term care benefit, it's interesting that it affects male and female differently in terms of a pricing. So, at some ages, a male might get the most long-term care. At other ages, a female might get the most long-term care, depending on the age of the purchase and some other factors. But by and large, because women are the most likely to utilize long-term care and be on claim longer, by and large, it is priced a little bit more expensively on females.
I know the answer to this, but I wanted to ask it anyway. Is there a joint policy available? Which there's not, but what are the alternatives to that?
Yes, yeah, good question. There's not a joint policy, but you can buy two policies on a husband and wife. And we do offer couple discounts. And so for a married couple or married individuals, you do get a couple discount. And actually both parties of the couple don't have to apply. Just simply being married does give you that discount. So there is that discount applied, and then you can purchase two individual policies. So what I would say, I know there are some pretty good joint solutions out there that really do mitigate the cost when you put a benefit pool on two individuals. Depending on how old the client is and what you look at, if you compare the pricing of two individual policies with Nationwide versus some of the other joint solutions out there, they might be close in cost, total premium versus total premium for two individual contracts. So it might be something to price out and kind of see what makes sense.
Any spouse riders is my next question.
There are not spouse riders, no. So no spouse rider, although, we do have some success in talking with generally a husband who has an uninsurable wife. We know that typically men would need care first. That's the general trend, right, based on mortality and morbidity. So we can buy a policy, maybe a little bit bigger policy than we might otherwise have purchased, so that in the event that the husband does need care first, but his wife has a condition where she's not insurable, he can take that income out of the policy and use some of it or save some of it for his spouse that wasn't able to get a policy. So that's maybe a unique way to look at the cash benefit.
Okay. I'm kind of losing my space here, so give me a minute. Okay, so is gender determined? So here's a new one. So is gender determined by birth?
It is determined by birth. Yes.
Okay.
Yeah. Despite any changes that might happen, mortality and morbidity factors are tied to the gender at birth.
Okay, and then I know the answer to this one too, but there is only one rate class. There's not a preferred. There's non-smoker and smoker, correct?
That's correct. There's non-smoker and smoker. So the pricing on the smoker rate would be a bit higher, and then there's the couple discount.
Right.
So with the approval, you either get smoker or non-smoker, and then either a single or the couple discount.
Okay, so the next question is, can you do a $50,000 single premium for a wife and then a $50,000 single premium for the husband? Which the answer is yes.
Yes.
And they get and they will get the couples to count as well, correct?
Correct. That's right.
Okay. My next question is, can a beneficiary of remainder be designated?
Absolutely. Absolutely. So you can name a variety of beneficiaries, trust as a beneficiary, contingent beneficiaries. There are multiple levels of beneficiary designation.
Okay. And I think you answered this before, but I think this lady jumped on a little late. Can the policy go into an ILET? And yes, it can. So because of the indemnity feature, correct?
That's correct. Yes. Yeah, so that slide I still have up is that example using the policy inside of an ILET. But we have a white paper, and Christy, I believe that might be something you have that you can shoot out after the call, but it is available if you have those clients.
Okay. I think that's it for questions. I want to thank everybody for joining us. Whoops, hang on a second. Maybe there's a couple more. If someone is denied based on health conditions, would they be able to reapply at a later date if the health is cleared?
Yes, yes, and we do try our best to indicate that with our initial review. So with our initial review, it might be a decline or it might be a postpone. We might say, hey, you know, this is a condition that we just haven't seen enough time since maybe a surgery or since the diagnosis of a condition to really give us a sense of the long-term prognosis. And so it might say, it might be, you know what, you can apply again in 12 months or you can apply again in 24 months. And if it's better, we would offer the approval. So we absolutely can.
And I believe this is the last question, and I think this is a yes and no question. Parkinson's and MS, they're an automatic decline, correct?
Those two are an automatic decline, yes.
Okay,
yeah,
and cancer, I'm sorry, go ahead.
No, I was just going to say the likelihood with those conditions that you would need care is nearly absolute. So, yeah, unfortunately, those are knockouts.
Okay, in cancer, I think that's a case by case, wouldn't it be?
It is, yeah. Prior cancer is not a knockout. You know, some of the more common cancers, prostate, breast cancer, some of those more common cancers, if it's been treated and the prognosis is good, it's in remission, then yeah, we will look at those and we will approve them. If based on the diagnosis and based on the form of treatment and then how much time it's been in remission. Typically post a few years, and by a few, you know, post 3 to 5 years in remission, those normally look pretty good.
And then as far as stroke, is that a case by case?
Yeah, a stroke, you know, is probably going to lean more towards decline. There are those TIAs, which are those minor strokes, right? And those we'll look at on a case by case. You know, depending on the stroke, if there's been, you know, full recovery, no limit to mobility, we'll definitely take a look. For cases like that with stroke, I would recommend that you do a pre-screen with us, and there's a pre-screen process that you work with Christy and myself to run, you know, that client's just general information about their stroke and their recovery and what their mobility is, and we can work with our underwriter to give a pretty good indication prior to an application. So that's a process we can do on those that have had stroke or cancer or other more serious conditions.
And I think that was the last question, John, and I wanted to end the call by saying for all our New York agents, you know, we can go ahead and start getting you contracting for that anticipated release of late April, early May, so you're just in place, ready to go. For all the locals around the Norfolk, Nebraska area, if you would like to join us for our Lunch and Learn next Wednesday, just give me a call. My number is 800-365-8800. 8208, and my extension is 4082. And John, I wanted to thank you. It was a wonderful webinar and very informative, and please don't hesitate to call me with any questions. We're here to help you, and John has been fantastic with us in helping our agents.
Well, thank you, Christy, and thank you, everyone, for holding with us throughout the call. I really do hope it was informative and hope you all have a blessed day.
So everybody take care. Thank you, John.
Thank you. Bye-bye.
Bye.